Hey guys, welcome to the podcast today. Today on It's All About Cashflow, we have a member of the Cashflow squad and somebody that I think this will be a fun conversation. Happens to be John Pezullo. John Pezullo is not only in mastery, but he is an accountant. And a lot of times you guys have heard me talk about accountants, attorneys, but you know what is exciting about John and why we have him here is not only is he an accountant, so not only is he going to talk about how to invest, what is the right structures, general advice, but more how does it relate to him. So having said that, John, welcome.
Well, thank you for inviting me.
Definitely. So John, kind of before we get into specifically investing, accounting, what your views are on how we should be doing things, why did you come to investing? Because we've made I picked on you a lot of times. Accountants are pretty boring people, right?
Sure.
And they try to find reasons why not to do something versus why to do something. So, and you happen to be a bona fide real estate investor, right? How did you come about to getting into real estate?
Well, not just an accountant, I'm a CPA too.
Oh, so, okay, yeah.
And I have my own company. So we have about 2 CPAs, actually 3 CPAs, an enrolled agent, a couple of bookkeepers, and we've been in business for about 45 years now. But during that point in time, some of my clients were real estate investors. And you see people come in, other business owners and real estate investors, and you see how they're doing. And they seem to be doing good. Now, they were just your typical 1 or 2 or 3 rentals, but they seem to be working good and building up some wealth. So I bought a property back before 2008 and worked with that. Had a rental on it, had the mortgage on it, and went through 2008 with the depressed prices, and I still had my rental. So it proved it to me that it would work. I never lost any money on it and kept going good.
So to frame this, right, 2008, everything crashes, and you carry that property through that. So even though the price came down, your rental income didn't dry up.
No, not at all. We bought it, this property we bought for $185. Price went down to $90,000. So if I sold, I would have been stuck. I would have been major loss. But the rental I had more than paid for the mortgage throughout the entire time. The person had to live someplace, so they had to pay the rent, and we kept things going.
Got it. So, and then you show up around us, right? Now, I tend to be a little bit more, and a lot of times when you're speaking in front of people, you're trying to educate them, you're trying to entertain them all at the same time, right? But the views that sometimes I have don't match the traditional way of looking at how people look at real estate, right? I mean, so I want to kind of break that down. So you're buying real estate based on 3 things. Number 1, cash flow. Number 2, equity. And number 3, your DCR has to hit.
Correct.
Right? Whereas in the traditional investment world, people buy it based on appreciation, and they buy it because it's a tax write-off. Right? We don't look at it. So can you explain that from your view? Because that's a different mindset, how we buy real estate.
So that's the difference between what my clients were doing and what I eventually ended up doing. They were buying because they get taught that property will appreciate over a period of time. So therefore, pay your 20% down, get your rents. As long as your rent paid your mortgage, in 20, 30 years, you'd have a property free and clear. But when I went into it, I went into more of the cash flow value. I want to make sure I was getting money out of it that would pay for it and keep going through. So when I buy a property, I don't look so much at the appreciation. Yeah, the appreciation is good, but it's a secondary thing. Primary is that I have 20 to 25% equity in it, and sometimes 20% if I have some cash left in it. But most of the time is you get the equity in there, but you want to make sure that the mortgage you have on it, plus the rent, or the rent less the mortgage and real estate taxes, you're getting cash flow out of it so that every month you're getting a paycheck. Money goes into the account, and you have enough surplus out there to keep going through. What you meant as far as DCR, as far as the value of it, you want to make sure your rents are covering your cost.
Okay. So to put this in perspective, right? I mean, you're not somebody who today, I mean, you play it down quite a bit, right? That's just your personality, right? But I mean, how many rentals do you have today?
We have 35 rentals in Illinois.
Okay, in Illinois, you have 35 rentals. You have another office in Vegas, right. So you're doing some investing there.
That's my house.
That is your house, okay. And then you're obviously now building in Florida. Right? So just in Illinois for 34 properties. Now, obviously, some of them are coming online, right, as we speak. But when it's all settled, right, what is that cash flow every single month net?
The cash flow for each property, we try to get $500 per property.
Okay, and so net. 34 properties will net you $16,000 or so a month.
Right,
net.
A 34.5 under rehab right now.
Sure, I mean those are just coming online. Mm-hmm. But the reason I'm pointing that out specifically, a lot of times when people think about rental properties, especially everyday bread and butter rentals, they don't realize you don't need a lot of properties. Guys, that's 16,000 net cash flow. This is not tax depreciation. This is not any of the financial games. See, and this is something I want you to address, which is a lot of times people say, well, but Andrew, I buy real estate because I get tax advantages. I'm like, you don't own a factory. You don't build a factory to get tax advantages. You do it because inherently it makes sense. Any of the benefits are above. Can you speak to that?
Right. Yeah. I mean, you hear of the tax advantage of depreciation you can take off the properties. You can take other expenses with the properties itself. But yes, you can do that. But it helps. I mean, if you want to have a tax write-off, you can get a loss on your rentals.
Right.
You have a $2,000 mortgage, but only have a $1,000 rent. I mean, that's easy to do. But I'm not in it for the tax advantage per se. It helps. They got cost segregation. You have depreciation you can take. You can take your mileage and things like that. But that's over and above what the basic model is. The basic model is the cash flow coming through. To that plus build up the equity.
Got it. So because a lot of times, so why is it like number one, you jumped in, you saw your clients doing something, and then you jumped into it, and you've kind of done it right. I mean, you're every year. 6, 7, if not more properties you're buying religiously, right? When
I first jumped in, I jumped in not under the mastery cash flow method. I jumped in under paying 20% down and doing it, making break even.
Right, doing it your way, right? And then you kind of adopted our way of doing it, which is you're buying properties with equity so that when you're refinancing, your money is all out.
Right.
Okay. Right. So why is it like people like you? Right. And as much as we kind of laugh at about that is that people like accountants, attorneys, real estate professionals, you're connected to the business, right? You're connected on the tax side, obviously. Why is it that people who are in the profession, right? And these are intelligent people. These are not people that are, I mean, they've clearly gone to school. You spend some time. Why is it that they give advice that yet they don't have anything to show for it?
I have 5 real estate brokers, agents, clients, and they will not invest in real estate. I don't know why. We keep telling them, it says it can't be done. It can't be done. But yet we show them.
Right.
It's just, I think it's a mental attitude behind it. Same way with the lawyers. They know that you can do different contracts and creative financing, but they don't want to get involved in it. Or they think it's too much outside the box. Once you get into it, it's very easy. I mean, picked up a property last week, and it was easy. It's just press the button. You get an addiction to it, but yes.
And I think what it is that like a lot of times, and the reason I ask that question is that genuinely we're supposed to be. It's like when you go to a doctor, right? You're supposed to respect the doctor. You're supposed to follow their advice. When you go to an accountant, right? You're supposed to because if I don't respect you, then why am I going to follow your advice, right? And you think a lot of times that, hey, you have my best interest at heart, right? And hopefully, but a lot of times what I feel from my end is that sometimes people will give you advice, but if they don't understand how your business is run, how it's structured, I'm not sure if it's necessarily the best advice if they've never done what you've done.
Correct.
Would that be correct?
That'd be correct. The person who has 1 or 2 rentals, they don't want to get into the rental business because they don't want to get messy with it.
Right.
And so they just keep the 1 or 2 rentals they got. They figure they can handle that, and they go for the tax advantage. And a lot of those people, they're high-level people. There's not that much tax advantage to them.
Correct.
But it's a shelter where they can put their money. Once you get into it and you drink the Kool-Aid per se, and start working with more properties, you then see that it's very creative. It's creative, but it's basic knowledge. And you can take it cookie cutter from one house to the next house to the next house on purchases. My typical purchases are very drab, not glorified. I'd say your 3-bedroom, 1-bath, 4-bedroom, maybe 2-bath house on a slab is the majority of my properties. We do have some other houses,
right.
Bigger and better, but your basic, easy ones,
everyday bread and butter properties.
4 walls.
Yeah, 4 walls.
That's what you're looking for.
Right. So now let's talk about, because I know everybody listening to this is like, okay, let's talk about some LLCs. Let's talk about S Corps. Let's talk about, so a lot of times when people are new, we all want, okay, give me that one thing that's going to make me rich. Give me that one thing that's the best way of doing things. A lot of times it's a little bit more complicated than that, right? But generally when you look at, say, LLCs, S Corps, whatever, if you were to generically talk about it, how do you look at it?
From the standpoint is you have those 3 flavors. You got the LLC, you have the S Corp, you got a C Corp, but C Corps are part of this. With the LLC, and then you got your own name,
right.
Things like that. When you're first starting out, the easiest way to do it is just buy the property in your own name, get a loan on it, and work that route. Once you get a few properties, the LLC is really there to maintain your property so that you can have some, I'm not a lawyer, so have some protection against it. But the main thing is you have the LLC after the fact, after your first couple of properties. And then you get to a point where you just use the LLCs for your properties. The S Corp is the same way. If you're going to do Airbnb or flipping, the S Corp is a good way to go too. It's the same type of deal. You can first get the property in your name, get started. You don't have to throw the money into it to get the structures going.
So you're saying something very simple. You're like, hey man, get some properties in your name, which is you're buying the properties, even if you get some hard money on the front end. I mean, obviously, if you're from Mastery, you'll get private money, right? And you can refinance it in your name. Now, obviously, there's a crowd out there that's listening to it, right? So if they've been on forums, if they've been on YouTube, oh, never buy a property. You're going to get sued. Oh my God, the tax liability on it, right? What do you say to that? Because a lot of times you have to, we'll laugh about that, hey, listen, get good insurance, right? That's the first place. And at the end of the day, your expense is an expense is an expense. Doesn't matter how you play games with it. Is what is the difference between if I buy the property in an LLC from an accounting perspective versus if I buy the property in my name and I have the same expenses at the end of the day?
Between an LLC and your own name, very minor difference. You still get the same expenses. You get the same income coming through. It flows down into your individual tax return. Taxes are the same. So there's no difference. It's more of a safety feature for the future.
Right. So there are a few different things that people have to think about. You have asset segregation. Mm-hmm. You're segregating, you have, say, 30 properties, right? You're segregating 5 per LLC. That's how we do it. Some people will do it differently, right? You may do it a little bit differently. And then there is asset protection, and then there's accounting. These are 3 different things. Right, and you have to find the right balance. Would you say that'd be correct?
That's correct. But I want to go back. You mentioned insurance. Insurance is the number one thing to do. You want to make sure you have the insurance from day one, but not only regular building insurance. You want to make sure you have liability insurance on yourself. Plus, get an umbrella policy. An umbrella policy will cover you for anything over and above your normal insurance. So even if you're sued on that property or that entity, and it's $1 million lawsuit, but you only have $300,000 in insurance, your umbrella would take care of that too.
Right. So
I'm just saying that you go the personal route versus the LLC route, you're still going to have the insurance on the LLC too. Correct. So it's just
and that's the level of protection. Yeah. So level 1 is, let's say you're buying a $200,000 property, you have $1 million in liability protection, right? That's what you have on all your properties, and then in addition to that, you have an umbrella on top of it. Right. So, and guys, this is this crazy notion of, oh my God, you have to be scared all the time. Guys, every hotel that is a Marriott owned, it has a big sign called Marriott, right? They don't hide who they are, right? Everything is public knowledge. There's nothing wrong you're doing. If you run your business by the book, there's no reason to be scared of running a good, legitimate business, right? So this is going to get me to, I'm not going to mention the names, there's a pretty well-known company out of Vegas, right? You're laughing.
Right down the street from me.
Right down the street from your office, right? And the whole concept of this is, oh my God, you're going to get sued. How do you protect yourself? How do you hide yourself? Like, this is the basic concept on which this whole thing operates. You need a Wyoming holding company. Then you have a company in Illinois. Then you have a company in Florida. This complicated structures. What is this for?
It's for if you're going to have large apartment buildings, hotels, things like that. Yes, it makes sense. But to have a few dozen single-family residence doesn't make any sense, or duplexes or four flats. I don't see that. Because in Illinois, if you have a rental in Illinois, you have to report that to the state. They know where you're at. And now there's a new rule coming through Securities, FinCEN, where they want to know who owns all these properties, one way or the other.
Right.
It really, I think it's out there, but nothing's really been done with it. But eventually, that animosity, anonymity will be going away. So even if you have your LLC out in Vegas and Wyoming, but you're doing business here in Illinois, people are going to know where to find you. Plus, they're going to knock on the door. They're going to see where the rent checks are going to, and they're going to track you down. I mean, it's very simple.
This idea, and this is something, if you're a big celebrity, right? If you're some big, huge celebrity and you're buying a big mansion somewhere and you have a bunch of attorneys on staff, big firms, they're going to put it in a trust and they're going to do all this stuff. Guys, listen, if you want to buy a couple million worth of real estate, you want to be worth 10, 15, 20, 30 million bucks. There's no reason to make it this complicated, right? You can protect yourself 100% with insurance. That's the first level of protection. Now, the other thing comes up is this whole idea of LLC in the structures and then the series LLC, right? What's your take on that? Because this is going to depend on the state you're in.
It does. Illinois, their LLCs cost a lot of money back 10 years ago. So I got a series LLC. A series LLC, you would pay for one LLC, and then every envelope underneath it, you pay like $50 or so. It was the big thing back 10 years ago to do. So you can put your 5 properties in each series, and then you'd be set. Nowadays, LLCs in Illinois are pretty cheap. So
that's probably one good
business. Series, but my new LLCs I got coming in, I do have more outside of that series.
Just separate LLCs. Yeah. Now, with you, obviously, you're in the business, right? You can run your books properly. You can do things properly, hopefully, because this is what you do for a living, right? Do you prefer to put one per LLC? Do you do it? We do 5, right? We do $1 million approximately per LLC, right? How do you do it for you?
You know the shoemaker who keeps his kids shoeless?
Right.
As a CPA, okay, we try to get 5 in each thing. But, it's sometimes easier to buy it in one entity. So sometimes I have 10 and then we move it over. But, But yes, you want to have 5 or 6 in each entity. And then, because then that envelope is further protection. And then, again, not a lawyer, but further protection because now you put it in different envelopes here. Then just one whole big ocean that they can pull from. The LLC structure, if you keep it with just one, then you're paying too much for each LLC for each property. It doesn't matter. I mean, you got one property and an LLC doesn't make sense.
So what we're talking about is this. Like, think about it. This, like John, right? You have 30-something properties, 34 properties. What are you going to do? You're going to have 34 different LLCs, and you're going to have one property per. In your property, you're making $500 minimum per property, right? Now you have for this year, guys, you're making $6,000. What is the cost of doing accounting for each LLC? Imagine the amount of bank accounts, right? I mean, like I have 30 bank accounts just because the amount of different things, and I have 5 or 6 per LLC properties. But it's a nightmare to be able to keep track of, right? And so you've got to try to make it simple and not more complicated.
Right, and if you put one in each LLC, then the accounting, you have one bank account for each LLC.
Right.
And likewise, it gets too complicated.
It's a nightmare of a scenario. So a lot of times my point with all of this is that there's a practical aspect of doing something, and then there's an aspect of selling a seminar, right? In a seminar, in a a 3-day type of thing you go to, the more complicated and convoluted things are, the more people are like, oh my God, I need that, right? And a lot of times people who have the least amount of properties have the most complex structures.
Right, and there's no need for that.
There's no need for that, right? There's no tax advantages. So, and another idea that is promoted all the time, they're like, Andrew, man, I'm not going to pay as much taxes. I'm like, listen, number one, how much is your income? Let's first talk about what do you actually make, right? If you don't make anything, don't worry about it because you're not paying much taxes anyways, right? Because I think a lot of times people, in trying to, number one, protect themselves and in trying to, quote unquote, not pay taxes, they spend most of their time there rather than actually creating something. Would you agree with that?
Correct. You're just running the gambit to run it, to do it. It doesn't make any sense.
Right, in circles, right? Okay. So what would from kind of where you sit, right, today, what would your advice be for somebody that wants to get started, right? Because a lot of times people are like, well, do I need an LLC? Do I need an S Corp? What is the right way of doing it? What is the perfect way of doing it? Or would you just say, no, you got to get started somewhere?
Well, going back to entity structure, we didn't get into this. An LLC, I'm sorry, let's go first. First off is just jump and get a property in your name. Piece of cake. Just got to start someplace. The LLC structure, and then if you don't know what you're going to do with that property, whether you're going to rent it, Airbnb it, or flip it, wholesale it, things like that, you can you can get the LLC structure. An LLC is really a disregarded entity. You can make it whatever you want. If it's just an LLC for a single member, it just goes on your individual return. It doesn't even show up anywhere. If it's an LLC as a partnership, 2 more people, then you have a separate tax return and you can do partnership stuff with it. You can also make your LLC an S Corp. So if you're Airbnb or you're flipping, you can make that election too. So you don't have to become a corporation to become an S Corp. You can take your LLC to the S Corp. Now, it's really a one-time decision to make, but at least if you get an LLC within that first year, you can decide what your entity is going to be like or what you're going to be doing with it.
So it's interesting you said that a LLC versus an S Corp, right? Is there a different tax treatment when you're doing a flip? Obviously, your tax, you're going to pay a little bit. Is there different treatment in terms of doing it from an LLC versus an S Corp? And you mentioned specifically regarding a flip and an Airbnb.
Right. For flipping, wholesaling, and Airbnb, you're in a business. So therefore, it's active business. You would be paying payroll taxes and things like that. To lower the payroll taxes and to shelter that money just on a W-2, the S Corp would be the way to go for that, because you're an active business just like my CPA company or any manufacturing company. It's active business. You have employees, you have transactions going through, and it works that way. In LLC, you can do the flips in the LLC and the Airbnb in the LLC, but that income that comes through, because it's active, you're paying Social Security taxes on all of it versus what you can do in the S Corp. So that's why the S Corp is more for the active business where you're flipping, making, and generally, if you're flipping 1 or 2 a year and you're only making $50,000, the LLC will be fine. But if you're flipping where you're making more than $100,000, the S Corp is
it's better structure, preferred structure. Okay, got it. And a lot of times, this is something that I see all the time. I'm like, the less moving parts that you have, right, the easier it is going to be. Because a lot of times what people don't think about, it, this is never brought up, is the practicality of doing business, right? That how are you actually going to conduct business? You're buying a property in Illinois, and supposedly you have this holding company in Vegas or Wyoming, Delaware, all this craziness. What people seem to forget is who's going to give you a loan on it?
Right. And that's even a difference between the S Corp and the partnership LLC. And especially now you got the extra entity in Wyoming. So the bank will want to make sure they got paperwork on everybody who's associated with that LLC and any LLC that owns it. Take, for instance, my daughter. She's in Mastery now, too, and we have partnerships together. Well, it used to be when I buy a property, I just sign my LLC and piece of paper with the bank, and they're happy because I am the owner of that LLC and I can buy the property, I can make the decisions. Now my daughter's part of it, and now we got to get her signature on things, and I get my signature on things for everything that goes through. If we had an entity that owned the partnership, now we would have to break out that entity and then get further documentation with the banks and the lenders. Again, adding extra layers to you. Now, do the layers work when you're sued? Extra hurdles to go over, I guess. But,
right. Listen, they work. The problem is this, right? If you're American Airlines and you have airplanes flying all around the world, you have a huge amount of liability. Clearly, probably they need to think about different business structures rather than you and I, right? But guys, to buy real estate, it's simple, right? You have a property you own in Illinois. Let's just say something simple happens, somebody breaks their hand, something happens. What's going to happen? At the end of the day, you're going to turn it over to your insurance company, right? Your insurance company is going to deal with it. You have proper insurance. There's nothing to be scared of there. You're not doing anything wrong. And these are everyday accidents that happen. There's normal. It's called running a normal business, right? These are not things, you're not afraid to get in your car and drive, where there's a lot more liability in that than anything else you can do. We all get in a 5,000-6,000 pound vehicle. We're driving 80 miles an hour, right? And I think what a lot of this is hype and nonsense to sell books and tapes and courses. I'm not against that. But I think we have to keep it what is reasonable for a business, right? And a lot of times people focus so much effort on, oh my God, something's going to happen to me, that you don't even do anything.
And you want to look at it. So you want to see what the risk is versus reward. I mean, you talk about the Vegas company. I listen to them. I belong to their podcast, but does it make sense for me? No.
Right. No. I mean, no, and reason I'm saying that is it's very attractive. I've done it. I mean, at one time in my life when I had nothing, I'm like, oh yeah, before I become a multi-gazillionaire, I'm going to basically protect myself. Protect myself from what? From who? Right? I mean, it's like you don't buy insurance in Canada if you live in the United States, right? You got to think about that a lot of times, that what are we doing and to what end, right? So having said that, is there anything else you think on your end that we haven't touched on? Because I know this is a very wide topic if we go down that path, but anything from your end?
Well, just on the LLC, the structure between myself and my daughter. So like I said, if you have a single member LLC, it's a lot easier to get the loans and everything going through. So you should always have one out there. I mean, it's very easy to buy the property. You do it quickly, you get the deposits going through and things like that. What you don't want to do is have the LLC perhaps with you and your spouse, because now you're a partnership. There's ways around it, but you're really a partnership at that point in time. And again, the bank is going to want both signatures. Well, if your spouse is right there and you're right there, it might make life easier, but it's still easier if you're just on your own.
Okay,
and
got it.
Have her have one LLC, you have another LLC, and then you just keep going with it.
Got it. Okay. And then another thing is, because you had talked about this at one time, right? Another topic we talk about that comes up a lot of times is cost segregation, right? Again, cost segregation is talked about, this magic thing where there's like, oh my God, you don't have to pay taxes. It's like, guys, listen, if you earn income, you have to pay taxes. If you have depreciation against it, you get to take that into account. You have some losses, you get to take that into account. What is this magic about cost segregation that it's talked about as, oh my God, this is just suddenly found money?
What is? And I'm one of those. I think it's really good.
Okay.
There's some people that don't believe in it. So, but cost segregation. So when you buy a property and you rent it out, you're going to take depreciation on it. And mind you, make sure you take the depreciation. I mean, you talk about my clients that come in. We'll pick up a client and they'll forget about the depreciation. And they never heard of depreciation over the past 7 years, so we have to go back and do that. So you always want to make sure you're taking depreciation. But,
so hold on, let's explain depreciation first, right? So I'm going to lay out a scenario and then you explain it. So here's what depreciation is, because sometimes this is a very important point. People are going to miss it. So depreciation means I buy a property, and we're going to keep it simple, $200,000. We say that the land is worth $60,000, right? And then 140,000 is allocated towards the built structure,
Right.
right? So explain first, why do we separate the two, or why does the IRS make you separate the two?
The IRS makes you separate the two, and realistically, you have land and you got building. Land is not depreciable. Land will be land, and you cannot expense out the land. The rest, the building entity structure itself, you get to write off, take a non-cash expense on your books over the 27 and a half years. So you divide that by 27 and a half. What is that?
So 140,000, if we divide that by 27 and a half, is going to be
5, 4.
about 3,800 or something like that a year, right? So you're taking 140,000, which is the value of the building, and you're depreciating on a depreciating schedule of 27.5 years, right? And so that's going to give you a value, and that value is what you can depreciate all the way for 27 and a half. What is it, $5,800? Okay, so $5,800. Okay, so now, John, let's assume that we have a income on this property, right, of let's say $6,000 a year, right? So I make $6,000. So this is after PITI. My net is $500 a month. That's $6,000 a year. Now what happens?
Off your $6,000 of income,
right,
you now get to deduct the $5,800.
So
you're left with a taxable income of about $200.
So on this particular case, I'm left with, this is why this is important, right? Which is you have $500 a month in cash flow, net after expenses. Then, so for the year, you have $6,000. You take that $6,000 and your accountant is going to offset that against the depreciation in that particular case. So you're paying taxes on $200.
Right.
Right.
Now your $6,000 includes your principal payment too. So it's
correct.
It's a little bit more than that.
Right. No, but we're making it simplistic.
In simplistic terms, you're correct.
Right. Okay. So now this is regular depreciation.
That's regular.
Right.
If you
this
go
is
to
just
your normal CPA off the street. That's
right,
what they're going to do for you. H&R Block, CPAs, EAs, they're all going to do it mainly that way.
Mainly that way. Okay, got it. Now we're taking it to the next level, which we're talking about an accelerated depreciation, right, or you're basically itemizing the items out.
Right. So cost segregation, you can do it one or two ways. You can, when you buy something, you can have each line on your books and records as far as what you pay for the furnace, what you pay for the fixtures, what you pay for the piping, and you have that all listed in your depreciation schedule. Cost segregation will be an engineering study that goes through and says, okay, there's this much in piping, there's this much in drapery, there's this much in carpet, and breaks it all down for you in a nice 1 or 2 page report going through. It's an engineering study. You have your actual or you get an engineering study. What that will do is when they break it down, your things like your cabinetry and your flooring, it's not depreciable over 27 and a half years. It wears out after 10 years, 15 years. And they call that, you got 5-year property, 10-year property, 15-year property. It'll break all that out in those sectors like that. In the past, actually 2022 and prior, they had what they call bonus depreciation, where if you had 15-year property, you can write off in the first year.
Right.
So you can get a vast deduction of depreciation against all your income and carry it forward. From an accounting standpoint, the IRS even looks at cost segregation as the proper way to do it, because now you're breaking out the parts of the house.
Right.
They want to know what your pipes are, what your electrical is, and what your roof is, how much is for the roof. Because let's say 5-10 years from now, you go to replace the roof. If you were under the regular 27 and a half years, you can't just write off half of your purchase price. You have to then do a study to say, oh, how much was that roof when you bought it? Or you just have to take that roof and depreciate it from then on in addition to your purchase price. So the cost segregation does help you out in the future because now you can match up your new fix-up cost against what you bought it for.
So when I made a comment initially, like a lot of times people look at it as found money. This is from my perspective. So accountant's perspective is going to be different. My perspective is, as real estate investors, our job is to buy good quality investment properties, be it depreciation, be it an accelerated depreciation or cost segregation. this is something everybody gets. You should talk to a good accountant. You should talk to a good CPA and get this. But to buy a property just because I'm going to get depreciation, or to buy a property just because I get tax advantages, that makes no sense, right? The important part is, am I buying a good quality property? Am I buying a good investment to begin with, and then all the advantages follow through, just like appreciation, right? Appreciation is going to happen if you buy a good quality property.
And let's go back on this property here.
Sure.
So of this, you had $200 of income.
Right.
Using the cost segregation, just in general, you'd have a $15,000 tax loss.
Tax loss,
Yeah,
right.
about
So
that.
now, so if I have a income somewhere else that's a significant amount of income, I can offset that against this tax loss.
Maybe.
Okay, so explain that.
So there's different types of real estate people out there.
Okay.
If you make more than $150,000, you're considered a passive investor.
Right.
This initial depreciation would not help you out if you don't have other passive income coming through. So you got to have passive income matched with your passive expenses, or vice versa. If you're under 150, the max you can take out is a net of $25,000 a year, and that's where the tax advantage comes that people look at.
Absolutely.
And then if you're an active real estate professional, which is a harder thing to do, then you can write off everything. But it's harder to do. It's more technical and things of that type.
So basically, let's explain what does an active real estate professional mean. That your time and your income, and that to 80, what is the break part of it where you considered an active real estate investor?
You have over 750 hours devoted to real estate business, and not from a W-2 real estate business. It has to be, you have to be 1099, or you own the business, or things of that type. And plus, you have to have more hours in that real estate business than any other business. So let's say my CPA business. I'm a W-2 salaried employee on that. That's 2,000 hours a year, more, 2,000, maybe 3,000 hours per year. There's no way, I can get over 750 hours, but there's no way I can have more hours than my CPA business. So I would not qualify. If you are married and your spouse is a stay-at-home person, he or she, depends on what's going on, might be a real estate agent. And if that's all they do, and they're not a W-2 real estate agent, 1099 real estate agent, then they might be able to qualify, because one half of the couple
is fully dedicated to real estate.
Yeah.
Right.
And that covers both people.
Got it. So say someone like you, my job is real estate. Right, full time. That's what I do all the time. Right. So then I can justify that because I'm legitimately in that particular business. Right. For you, you're an accountant and a real estate investor, but for your personal income, a bunch of it obviously comes from your business, and this is on the side, as we can say.
It's still a side business.
Yeah, it's a side business as for your rental income. Okay, so we kind of talked.
But the other thing on cost segregation,
sure,
you don't lose. Let's say you can't use the whole $25,000 loss that year. It will carry forward into future years.
Right.
And like I said, you also have the benefit of when you sell it, now you know what you're selling. Carpeting, it's not carpeting, but there's some price to it, so you're not going to be paying taxes on that. And then if you're fixing it up and you got to redo the carpeting 3 or 5 years from now, you can just take that direct write-off. You know what's going on with it.
Yeah, that becomes
I really like cost segregation. And the other thing, too, you don't have to cost segregate every property that you have. You can pick and choose what you want to do.
Right.
And then you can even do it for the past properties, too, if you run into something in the future.
Right. And I personally am of the opinion that initially when you start, keep it simple. Right? Start accumulating something, start accumulating the properties. Don't get bent out of shape over a lot of taxes, guys, listen, unless you're making some money, you don't have to worry about those things, right? If you're genuinely, if you are making $100,000, $200,000, $300,000 and you buy good quality real estate, believe me, there's a lot of tax advantages you're inherently going to get because you own a lot of real estate. Right? So you don't have to spend, but what I see happening a lot of times, John, is that there's a huge group of people who'll spend nonsense amount of time worrying about the taxes, worrying about, oh my God, what if this happens? They don't actually do any real estate. And yet all the time is spent in nonsense things, right? It's like when you open a business, it's really exciting. Put your logo on there, get business cards made, get all this nonsense done, rather than going and making some sales, right? And that becomes really, really important.
And it's not for the beginner person. I mean, basically, just like you don't have to have your structure set up ahead of time. I would not do a cost segregation study on the first house that you get.
Yeah, that you can grow into it and start creating some income first, and then make sure you get a good accountant, good person to give you good advice, right? So that you can actually do that. So having said that, John, this has been really great. Any points that I did not touch on that I missed that you had in your notes?
Nope. You touched on everything from that standpoint.
Right.
But if you just off of the real estate side, just when you're doing a tax return this year, and we saw this too, the charitable contributions last year, it would flow through $300 per person. If you didn't itemize, that's gone. So, and there's some other ones that change, but that's the main one that shows up there. Please find it.
Got it. Great. So obviously, if you're from Mastery, you know how to get in touch with John, right? If you are not, you want to put out your number?
Sure. I'm not cheap, though. If you got one or two properties, we're not picking you up.
Okay, got it.
But 630-690-0995 is the office number. And tell me from Mastery and get a hold of me. But it's
630-690-0995. 0995.
Yeah.
And it's John Pezullo. John, this has been a pleasure. Congratulations, number one, on your success.
Thank you.
And what you have achieved. So, because a lot of times I've picked on accountants, attorneys, and my point to picking on them is not to pick on them. It's just to say that, guys, listen, be very careful who you take advice from, because you want to take advice from good professionals, but they need to understand, what do you really do? And are they tailoring their specific advice to what you do? Because if they've walked your shoes, they're better able to help you, and they're able to better help their clients in that profession. Having said that, again, everybody from Cashflow Squad, which is all of you, welcome to the Cashflow, It's All About Cashflow podcast. Share this with your friends and with your family and help us grow. If you have a great guest that you think we can have on, please get in touch with us. Thanks a bunch and have a good day.